Hello everyone, welcome back to Upside Down Data. Today I want to talk about how people misvalue losses and gains and why that can be a problem from a cognitive science perspective. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So you may have heard of the term loss aversion before, and that's this idea that losses loom larger than gains. And what we mean by that is that people are oftentimes more motivated to avoid losses than they are to achieve gains. And this idea of loss aversion actually originates from a psychological theory called prospect theory. And this graph I'm showing you here really lays out the tenets of this theory rather nicely. So I'm going to walk through what we're seeing here and then talk about why this matters, why we should care. So there are two axes that are being displayed here. One is just kind of the outcome. Are you in loss? Are you in gain? Or in a financial context, like with crypto investing, are you in profit or are you in loss? And then value, and really what value kind of means is more or less impact, kind of the magnitude, how strongly you feel. And positive values, if you're in profit, like in crypto, it's probably going to be happiness, right? That's going to be kind of the emotion you're going to experience from achieving this gain. Whereas being in the negatives here is likely to be pain or some kind of feeling like that, right? Where you're in loss, it's an unpleasant emotional state. So, could think of this as positive emotional experience, negative emotional experience, kind of whatever that specifically might be, frustration, anger, etc. in loss. And what this line is trying to say is how people actually experience the relative extremity of happiness or positive emotion, for example, up here, or that pain, that negative experience down here. And essentially the idea is that this is a non-linear function. So the way it works is that when people are going into gains, the perceived value of that gain increases really quickly early on, right? So early on, kind of the value or the positive emotion or whatever, however you want to define that, it increases quite quickly early on, but you'll notice that it tapers off then at a certain level, that once you get to a certain level of gains, more gains above that doesn't really feel all that different psychologically than having a little bit less, right? It's all roughly the same. If you're in, let's say, 15x profit, then suddenly being in 17x profit might not feel all that different, even though going from 0 to 2x or 3x profit might feel like quite a lot. That's the idea, that the more gains you're in, the less that you're kind of seeing that as being an additional value. It all kind of feels the same. But if you're in the loss category, and so this would be loss of value or an increase of pain or negative experience, that sort of thing. In losses, you'll notice that it goes a lot more deep before it starts to shallow out and then level off down here. So again, it is the steepest right as you start experiencing losses, right? The earlier the loss you experience, the more that you experience that loss of value, that psychological experience, this objective feeling of value or pain, negative feeling increases quite quickly, and then it tapers off just like with gains. But you'll notice that with losses, it takes longer for that tapering off to happen than for gains. And that's really this idea of losses looming larger than gains. This idea that people are more sensitive to losses than they are to gains further down. But in both cases, it's a nonlinear function, right? That the first bit of loss creates a lot more pain than loss deeper down the line, right? If you lose, let's say you invested $100 into some asset, some cryptocurrency or some other asset. Let's say that you lose 70% of that. So you're now down to $30 in that investment. That'll probably take you down on the curve. You've experienced a 70% loss. That's going to feel quite bad. But then let's say that you lose another $5 off of that, right? So now you're down $75 total. Well, that $5 at that point probably doesn't feel all that much different than being down $70, right? 75 versus 70 is kind of similar. Whereas if you're up here and you're down $5 and you're suddenly down $10, you've doubled how much you're down by. It might feel like a more extreme thing. Or, you could think if you put $1,000 in, losing that first couple hundred might feel worse than losing, 100 way down the line when you've already lost 80% of your investment, or whatever the case may be. That's the idea here, is that that initial pain that you feel is going to be greater than kind of the same amount of loss will feel less painful or increase your pain less than it did up here. And so that's the idea of prospect theory, really, is that people experience losses and gains differently, and losses tend to be overall more painful, so people tend to be more just kind of loss averse. They don't want to experience this loss because they see that as having more of a magnitude and effect on them than accruing gains. And so really with prospect theory, what I want to focus on today is how this makes cost bases very important and why it's something that people talk about a lot, and potentially why these are things to keep in mind. So there's some on-chain metrics for Bitcoin, for example, that let us quantify what the average cost basis is for different types of holders. So you've probably seen this before, right? What I'm showing you here is a chart that I pulled off of chainexposed.com. And this is showing the short-term holder realized price. And so realized price is just basically the price at which a coin was spent. And then, of course, if a coin is spent at that price, someone bought it at that price, and it becomes that new owner's realized cost basis. So the realized price of the person who sells, then that becomes the cost basis of the person who bought it. So really, this is just the average cost basis of short-term holders. That's the way you can interpret this red line here. And people have often noted that this line has been very important historically, the short-term holder essentially cost basis. You'll notice that's oftentimes acted as support and also acted as resistance throughout Bitcoin's history. So, acting as support all the way through the 2017 bull run, acting as resistance going down into the bear market in 2018 into 2019. And so the cost basis has seemed to be important. And from the perspective of prospect theory, it makes total sense why this should matter. The idea being that when people fall below their cost basis, it becomes painful very quickly. That the second this is breached, people start feeling a lot of pain, and people can start capitulating. And then if they ever get back up to that cost basis, they're coming off of feeling all this pain that's felt really unfortunate, really unpleasant. So yeah, they're just going to take profits at that point. Why wouldn't they? They just experienced all this pain. Maybe they just want to get out while they can, while they're at break even. And that's one of the reasons why it can act as resistance. And then conversely, the reason it can act as support is that people don't want to fall below their cost basis. So they might be willing to step in and buy more at those points to kind of defend that price level. And so it has this kind of dual meaning. But the idea, especially in bearish times like we're in right now, is that once we fall below this point, the pain that's being experienced by short-term holders ratchets up quite quickly. It ratchets up very quickly. And again, this makes sense. The second that you're in loss, so assuming that 0 here is kind of the reference point, going from gains to loss, as soon as you're in the negatives, suddenly that pain starts racking up really quickly. Just in very little amount of loss, people are going to be feeling a lot of hurt. And then that might lead them to capitulate, or certainly if they are able to hold on until price gets back up to their cost basis, they might just get out while they can, so they don't have to potentially experience that again if the price drops back down. And this might be one thing that we can use to understand why short-term holders often have been kind of capitulating recently. They've been the main drivers of selling in this recent correction we've had. So what I'm showing you here is another graph from Chain Exposed, and this is just showing shifts in. What I'm showing you here specifically is shifts in short-term holders' cost basis, basically, or realized price. So the idea is that people in these kind of dotted red lines, these are people who bought Bitcoin up above 60K. They sold these down into these dark red bars. So coins that were purchased up above 60K, for example, shifted down into this range that we're at right now. And so that's the way you can read this, is that this is a reduction in short-term holder supply, meaning that these coins were spent. These solid red bars are an increase in short-term holder supply. This is where people bought these coins that were sold. And you'll notice that a lot of short-term holders have capitulated off of their purchases from the all-time high, being well below their cost bases. The pain ratcheted up really quickly, and it finally became too much, and they sold. Even folks down here ended up selling into this range. And now price sits here. And it makes sense from prospect theory why we'd expect this to happen. Because again, once you're below your cost basis, we know the pain racks up quite quickly. And so these people have succumbed is kind of the idea. Then, of course, with cost basis, it can go the other way if people are above it. So this is the long-term holder cost basis. So these are people who are defined generally as people who've been holding the coins for more than 155 days. And it's just basically the average cost basis of that group. And what you can see is that the long-term long-term holder cost basis tends to be quite a bit lower than short-term, which just makes sense. They're older coins. Bitcoin goes up with time, so it makes sense that the cost basis of people holding for a longer time will be lower than the shorter term. And really with the long-term cost basis, it's very rare for us to dip below it. It's really only in extreme kind of bearish points in the market that we end up falling below it. But one of the things to keep in mind is the distance between the cost basis and price, right? Because one of the things you might think is that the further away price gets from the long-term holder cost basis, the more likely they might be to sell, right? You might think that, as we get more and more multiples above the cost basis, that's more and more incentive to sell. But in fact, prospect theory actually suggests a slightly different perspective on that. That actually price being this far off the cost basis versus this far off might actually not matter all that much. Because with gains, they start to feel the same very quickly. Again, look at this part of the graph here. As people go into gains, into profit, very quickly, it all feels the same. If I'm up 15x, 17x, 20x, as that increases, it just doesn't really feel that different anymore, kind of emotionally or psychologically. It's all just kind of the same. If I'm up 100x versus 102x versus 105x, it all just kind of starts feeling the same after a certain point. There's not very much differentiation on a psychological level based on that. And so from that perspective, then, we might not expect long-term holders to view this point in the market as being all that different from this point. So if they were going to sell here, they'd be just as likely to sell here. Or if they're likely to sell here, they'd be just as likely to sell here from that purely psychological perspective. That there's not necessarily, from the prospect theory's perspective, all that much more reason why people should feel like they've gained a whole lot more here than here. It should actually start bleeding together relatively quickly at some point. And this might be why we haven't seen long-term holders give up yet. That, they were a lot more in profit when we're up at 60K. You'll notice, there's been some spending down at the 10K level down here, but it's pales in comparison to the volume that's been spent by short-term holders up here. The selling pressure right now in the market is really not coming from long-term holders. And again, I think this makes sense because, again, if you've been holding Bitcoin since under 10K, if you're up at 60K and then at 30K, maybe it's just not experiencing that as being very different. Maybe 30K is here and 60K is here. It all kind of bleeds together. And so from a purely psychological perspective, people who are holding from here might just say like, whatever, it's come down from 60K to 30K. I'm still very happily in profit. I'll just wait. I'll hold on, see if higher prices come. Because from a psychological value perspective, it's not all that much different to me. And so there's not that emotional urge to sell necessarily like short-term holders might be experiencing. They're experiencing a quick ramp up in pain that goes a lot deeper than the amount of enjoyment these people are getting from being in profit. They're probably not differentiating all that much between 60 and 30K. They might just be seeing this kind of this general range that's not good enough yet for them to be convinced to sell. They're going to wait for higher prices. But even though price has fallen 50% off of 60K, that's still not enough for them to be like, well, I'm going to lock in profits. Because for them, they might not really experience that loss that much. That unrealized loss from 60 to 30K, they might just be like, well, whatever. I'll just wait a little bit longer. It doesn't feel painful. It doesn't feel painful because it's all in this flat line of the gain section potentially. So that may be one reason why long-term holders haven't been adding to the sell pressure. Because again, they're healthily in profit, so they're not all that concerned. Where things could get dicey, could get problematic, is if price started to capitulate down into their cost basis. Because then you're going to start getting into this point where they'll actually start experiencing that pain as they start losing that gain, which might lead them to end up then selling, which could end up leading into one of these final capitulations like we've seen in the past. Okay. So one thing I do want to mention then, just based on what we've been talking about, is one of the things that I think is one of the kind of issues I have with this very common metric that's often talked about on chain, which is the MVRV indicator. And essentially what this is just simply the ratio between the market price for Bitcoin and the realized price. So it's basically the ratio of the current value of Bitcoin compared to the average cost basis in the market. And the idea with this indicator is that, the idea is that when this really spikes up high, that's a place where people are highly incentivized to sell because they have a huge amount of unrealized profit that they're sitting on, so they just want to get out of the market at that point. Of course, one of the issues of this indicator is it doesn't take into account diminishing returns, right? So that you can expect people's unrealized profits to get a lot higher when the market cap of an asset's smaller, because then the asset just has more potential to move really high up to the upside. Bitcoin back here was able to put in massive percentage moves to the upside. It's a lot more easy for it to do it when it's a small cap asset like it was back here, versus where it is now, being a much larger asset. It's just not going to put in the moves like it did back here. This value will never get as high as it did back here, most likely. But if we're thinking about this in the context of prospect theory, in some ways this is all kind of nebulous, because we know that at some point, the psychological experience of a gain stops mattering too much. There's some cutoff where increases in the monetary value isn't going to translate into psychological increases in perceived value. It all kind of bleeds together. And so really, with this value being this high or this high, it's probably unlikely that people are differentiating all that much. I think what's more important for this kind of metric is not to treat the y-axis here as being linear, which is what this is doing. It's just saying that on a linear scale, where is this? We know that people aren't evaluating value on a linear scale. People are using a kind of curvilinear or logarithmic curve to evaluate value as they get into more gains. And so really, with the when you look at this, if you're looking at where we were up here, when this was happening, you probably would have thought, this isn't that scary yet. We're not all the way up here yet. But in fact, this could have been quite scary, because we could have already been getting up to the point where people are reaching maximum value, and maybe then that's just hit their threshold to start selling. They don't necessarily need it to get as high as it did before it starts feeling like really high gains, and then they might then start taking profits. And so that's just one of the issues I have here, is that this doesn't account for diminishing returns, and then it also doesn't account for that psychological factor. And especially because this is really built on a psychological principle, the idea that people, the further they are in profit, the idea is that the more motivated they should feel to sell. It's not, according to prospect theory, actually probably the way it happens. That people feel more and more encouraged to sell up to a point, then anything after that's all about the same. And so there's not going to be more and more selling pressure as price goes up higher and higher and higher. So just something to keep in mind when you interpret indicators like this, is that these are assuming a linear relation between the monetary price and people's perceived value, which might motivate them to sell. In fact, we know that's not the case. So yeah, and then the final thing that's important to note here is that cost bases matter less the further away from price one is in either direction. And that's essentially what we're saying, is that when you're in extreme profit, the further away you get into extreme profit, kind of the less it matters where your cost basis is, because at that point, all this kind of feels the same psychologically. And the same actually is true for negative, right? For being in loss. If you're in loss, it hurts a lot up to a point, but then it kind of flattens out. And once you get really far below that, then you just kind of get numb to it. You're not really all that concerned. And then any increases in loss aren't really going to impact you all that much. So to wrap this up, I want to talk about then, how is this actually losing people money? Or why is this something that people should pay attention to and can be a problem? Well, there are a few things to keep in mind here. So one is that it can lead people to start panic selling a little bit too early, and potentially end up panic selling local bottoming points. So, it's too early to tell right now if we're at a local bottom or we're going to go back up, but that could happen. And if that did happen, what could happen is that those people who bought at 60K, who finally capitulated down in the 30, 40K range as they got into, further down to that steep part of that logarithmic curve into the loss, then they just said, all right, this hurts too much, I'm out. But that might lead them to people to actually sell at the worst possible time. Whereas if people experience a more linear relation between that pain and that loss of profit, it would take a lot more loss before they might actually start seeing problems with that investment. But then the flip side of this, the kind of the opposite side of this coin, is that logarithmic function on the loss side can also get people into trouble when they actually hold all the way through into that leveling off point at the bottom. Let's say you bought some really speculative altcoin and it dropped, 85%, right? So it dropped 85%. And you ended up holding through it. So the person was able to, hold through the pain even at the 85% loss down. Well, at that point, if you've already held through 85%, then any loss beyond that's probably not really going to push you to selling at that point, right? Because it just doesn't feel that much different. If you basically say to yourself, well, if I held at this long, I'll just keep on holding until it goes back up. One of the problems with that, though, is that it can kind of make you numb or make you blind to possibility that the project is just a failed project. It's never going to recover from that 85% downtrend. It's actually just going to go to zero. And then what will happen is people suddenly just go down with the ship. They just never sell to get any value back out of it. They just hold all the way to the bottom. So those are kind of two different ways that this can lead people astray. Because on the one hand, it kind of lead them to sell too quickly and then sell the local bottom and then get left behind if the thing ends up pumping afterwards. Then on the flip side, it also can mean that people hold on to things way too long after they've really dumped in price, because at that point people are just kind of numb to the downside. No new downside motivates them to sell, and maybe objectively it becomes more of the case that that project is just not going to go anywhere. And certainly with altcoins, we know this happens all the time. Altcoins fail, and there are plenty of people who just end up holding useless or worthless bags after they do fail. So just some things to keep in mind from that perspective, how this can relate to those kind of phenomena. And then the other thing that's important as well with this is that people just sometimes won't take profits when it's prudent. Because again, when I was with the gain side, the fact that it goes on that log of the curve, and then at a certain point it just flattens out. If people kind of hold throughout that initial kind of growth thing and get into that plateau point, then if the value doubles from there, people might just say, whatever, I'll just keep holding on to it. It doesn't, that gain of another 50% or another 100% didn't really feel that meaningful. I'm just going to keep holding on to this, see if it can go even higher. And then people lose the best opportunities to sell. So for example, someone holding Bitcoin from 3K, for example, when it got up to 30K, they're probably very happy. Got up to 60K, maybe that just didn't feel like enough of an increase. They were just like, well, whatever, I'm getting a ton of profit, I'll keep holding, hoping it goes 100K. And then of course the market crashes 50%, they lose a huge selling opportunity in doing that. So that's another way that this can end up kind of losing people money, is that you become insensitive to how far you are in profit, and maybe don't take as much profit as perhaps you should based on the kind of increase in profit that's happening in the market. So there are other ways that this affects investment, but these are just kind of the ones that I want to highlight here. And one of the things I want to just end with is I think that this kind of highlights to me the usefulness of having indicators like risk indicators, like the upside downside potential indicator, which is what I'm showing you here for Bitcoin. So if you're not familiar with this model, it's a model we have here at the channel that quantifies risk in Bitcoin. So when Bitcoin is high risk and when it's low risk. And the nice thing about indicators like these is that they let you take that emotion, that psychological subjectivity out of the equation. And instead you just have a number that you can evaluate. And if it's the case that Bitcoin's sitting up at elevated risk, or even here, elevated risk, then it might be prudent at those points to take some profits off at that point. Whereas if Bitcoin's sitting down here, you've experienced a lot of pain going into a massive drawdown, sitting down here, then instead of just panic selling out, capitulating, this can say, well, wait a minute, we're already dipping so far down, the realistic downside potential is getting tapped out. This might not actually be the best selling point at this point here. So things that can help you kind of take your emotions out of the equation really help. And prospect theory is just one of those things that feeds into how our emotions can get the better of us. We just make poor decisions where we don't take profits soon enough during these big runs to the upside, and then we capitulate out too soon when we're going to the downside. All right, so of course none of this is financial advice, but just to kind of talk a little bit about prospect theory and how I see it being relevant to crypto investing. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, we're all going to make it.